Let's talk Morgan Stanley now, shaking up their ratings in the quick service restaurant space. The analyst there has upgraded Domino's to overweight, has downgraded Joe's favorite stock, Chipotle, to equal weight. Domino's getting a bump today. Chipotle's down slightly. Chipotle's been on a huge run, though. Joe, I'll give this to you first.
Interesting call. I could see from a valuation standpoint where they're going with this. When you're looking at Domino's, you're talking about a $10 billion market cap company defined as small cap. Chipotle fits perfectly as a mid-cap stock, somewhere around $19 billion.
You know what Chipotle's up year to date? Sorry to interrupt, but I'll quiz you right now. Year to date, what is it up?
Year to date, Chipotle?
Yeah. How many percent?
60%.
You looked. You cheated.
He did. He looks at my notes and he's looking at that. I mean, you know.
I look at your notes.
As usual.
Your notes. Okay.
It's up 60.
Okay.
All right.
I do own the stock.
I know, but what do you think of the call?
I just told you.
Get it?
I'm not getting out of Chipotle. I believe in the turnaround story. I believe in the CEO message. I believe in the execution of the message. That does not mean that Domino's can't continue to move higher along with it.
Domino's has been a big laggard.
It has. Domino's is starting to recover, bounce. It's a name I've been in. I'm not in the name now. But if we're going to pick on Chipotle, they're going to come out.
Well,
they're picking on my Chipotle.
Well, they just take it to neutral.
All right, are they going to pick on
But
McDonald's?
they raise the price.
They're going to pick on McDonald's tomorrow? McDonald's
Maybe
is
McDonald's been hitting a new high every day.
Every day. Every day. 191 heading above 200. Here it comes.
Well, and one of the things that we've talked about, I think, you know, Joe and I were going back and forth at one point about labor and the share of revenue that restaurants spend on labor costs. It's anywhere from 55 to 65% in general, on average. But if you look at a company, you know, we're looking for those companies that are innovating and using technology to enhance their productivity. You know, Domino's has called themselves a tech company that sells pizza. That's nothing new, but they are, you know, doing a number of things that could help mitigate some of those late cycle pressures in terms of rising wages. Wages right now are not concerning, but there is, you know, some upside risk to that 3.2% average hourly earnings.
All right. What about this Domino's side of the equation? They say it's undervalued for growth. You haven't given Domino's enough credit for their technology.
You're
right?
He did a little worse than that.
Am I right?
He did a little worse than that.
You're right. Look, so listen.
Trying to be nice.
I know. So can we get the "I was wrong" out of the way and move on from that?
No, but I'm just simply saying they say it's undervalued for growth. Everybody loves the technology angle of Domino's.
So I've got to answer with a question.
Submariner in front of me,
who likes submarine sandwiches. Look, I've got to answer it with a question because I honestly don't get why, in a hyper-competitive industry where minimum wages are going up, margins are going down, hyper-competitive, why these stocks trade it, in Chipotle's case, 50 times, in Domino's case, 26 times, McDonald's, 22 times. Just somebody educate me, because as an analyst, that makes no sense to me.
Some of them are actually doing what's right to set themselves apart. Starbucks.
Love Starbucks.
Stock's up big.
I love Starbucks. But
why?
Look, when we talk about growth,
right?
We talk about growth.
Digital.
Look, I'll be the pinata here. I don't mind doing it. Sometimes it's my role on the show. But look, when you think about the price that you're paying for growth, okay,
Really
you look
underselling yourself.
You look at the PEG ratios of these stocks, and I would say, why shouldn't I be in something that has a PEG ratio of 1.5 times?
Well, then give me a pick.
You know I'm in Starbucks. You know I'm in Starbucks. I like Starbucks. And that actually does have a meaningful multiple in the low 20s. I like the cash on the balance sheet. I like the Nestle deal. I like the growth in China. I'm willing to pay for that growth. But that's, for me, at the upper end of the valuation on a PEG ratio basis that I'll pay.
We got to leave it there.